Welcome back to the deep dive. You know how it goes. We take a massive stack of source material, synthesize the absolute core of the knowledge, and deliver those critical insights straight to you. Today, we are deep diving into a topic that is maybe the single most foundational concept in all of modern finance and society. Debt.
It really is. It's a concept that sounds so simple on the surface.
Right. You hear debt, you think credit card bill.
Exactly. But as our listener sources really lay out, debt is the mechanism that powers, well, everything, from international trade deals to your local town's infrastructure. And of course, it has this deep psychological power over every single one of us. It is, at its core, an obligation, a requirement for a debtor to give money or something of value to a creditor at some point in the future.
That's it. And our mission today is to go way beyond just balancing a checkbook. We're going to distill the essential mechanics, sure, but then we'll explore the really sophisticated kinds of debt used by huge corporations and governments. And then, and this is the crucial part, we're going to uncover the surprising psychological vulnerabilities and the profound social costs that come with this foundational obligation.
We need to know not just what debt is, but how it structures our world and who it affects the most.
And that universality is it's the key takeaway right from the start.
It is this financial tool. It applies to a student paying for tuition, a city issuing bonds for a new subway line, a tech company funding its R&D, a sovereign state managing its budget. Debt is, it's the invisible fuel of the global economy.
Okay, so let's unpack this with a great historical nugget because we can trace this idea back for millennia. Even if the English word itself is comparatively young, the term debt only entered use in the late 13th century.
And it comes from the Latin verb debere.
Which means?
To owe, to have from someone else.
To have from someone else? That's really powerful. It suggests this transfer of immediate resources or power in exchange for a promise you'll make good on later.
And that intellectual root is why we use it as a metaphor today. When you talk about a debt of gratitude, you're acknowledging a non-money obligation you feel you have to repay because someone did something kind for you.
The moral and the financial worlds are tied together by this one core idea of obligation.
All right, let's start with the architecture of commercial debt. Since our listener is already pretty well versed in finance, we can probably skip the absolute basics and jump right into the critical variables. So when we talk about debt, we're obviously talking about principal and interest. But what really matters is how those two things interact over time.
Precisely. The principal is the foundation, right? It's the amount you borrow or that's invested. The interest is the cost of borrowing it. But the real complexity, the thing that trips people up, is compounding frequency.
Right. Is that interest just calculated on the original amount, or does it compound? Is it calculated once a year, every month,
or even daily? And that's where the numbers get really wild for the borrower. If you have a loan where the interest is compounded daily, like a lot of credit card debt, your effective interest rate is actually way higher than the advertised annual percentage rate, the APR.
You're paying interest on the interest you accrued just yesterday.
Yeah.
It makes debt grow incredibly fast.
It's an exponential curve.
It is. And an individual might understand the principal amount, but they almost always underestimate the explosive growth that frequent compounding creates. It can make the total amount you repay, just astronomical, especially over a long period.
So once you've got principal and interest set, the contract has to define the repayment structure. And our sources point to three main ways this is done, each one really optimized for different situations.
The first one, and it's the cleanest, conceptually, is maturity.
Meaning?
It means the entire principal balance is paid back in one single lump sum right at the end of the loan's term.
Okay, so that minimizes your immediate cash flow problems.
For the borrower, yes. But it requires huge discipline or, a guaranteed pot of money coming in the future. It's pretty common in short-term corporate finance or for certain bonds where a company knows it's going to sell a big asset and can use that cash to cover the principal.
Then we get to the one everyone knows, amortization. If you have a mortgage, you live this every month.
Amortization literally means killing off the debt, but gradually. The principal balance is methodically paid down over the life of the loan.
So every payment you make is split. Part of it goes to interest, part of it goes to the principal.
Exactly. And early on in the loan, most of your payment is just covering interest. But as that principal shrinks, more and more of your payment starts to chip away at the principal itself, which speeds up the payoff. It's all about stability and predictable risk.
I want to touch on a nuance here that can really catch people out, which is negative amortization.
Oh, that is a highly risky structure.
Because with standard amortization, the principal goes down. But here,
Here, in some really complex loans, maybe with super low initial payments or adjustable rates, your monthly payment might not even cover the interest that's due that month.
so what happens to the unpaid interest?
It gets added right back onto the principal balance. So the principal actually grows, it amortizes negatively, you're making payments, but your debt is getting bigger.
Wow. Who would ever choose that?
Someone with a very aggressive short-term need for low payments and let's say, a very high tolerance for risk down the line.
And finally, there's the hybrid structure, the balloon payment. It sounds exciting, but it seems like it carries the most risk of just falling off a financial cliff.
It does, because the loan is only partially amortized. Your regular payments are low, they cover some interest and a tiny bit of principal. But the contract says that at maturity, a huge remaining balance, the balloon, has to be paid in one enormous sum.
Why would say, a real estate developer pick this?
Because they're confident they can either sell or refinance the property before that balloon payment is due. It keeps their cash outlay low while they hold the asset.
But if the market turns,
Or their sale falls through, they face an immediate disaster. They could lose the asset entirely. It's very high risk, high reward.
and that leads us, inevitably to when the whole system breaks down, default provisions. This happens everywhere, from individuals to entire countries.
Default is just the breach of the contract. You fail to make a payment you're supposed to. And the consequences really depend on one thing. Is the debt secured or unsecured?
Okay, so with secured debt, there's collateral. Let's say a lender gives you a loan for a car. If you default, the creditor has a pretty clear path.
Exactly. They can move to repossess that specific collateral. The car, the house, the business equipment, whatever was put up to secure the loan. The value of that collateral determines how much of the debt gets covered by the repossession.
But what if the collateral's value has plummeted? The car loan was for $30,000, but the car's only worth $20,000 when they repossess it.
That's a very common scenario. It results in what's called a deficiency balance. The creditor sells the car, they apply the $20,000 to the debt, and the debtor is often still on the hook, legally, for that remaining $10,000, plus legal fees.
So secured debt doesn't guarantee the creditor gets all their money back.
Not at all. It just gives them recourse on a specific asset.
And when the problem is bigger, when the inability to pay is just total, we get to the most serious situation, bankruptcy.
Bankruptcy is the formal legal process for both people and companies who just can no longer pay their debts. For an individual, you're looking at Chapter 7 or Chapter 13, which either liquidates or restructures the debt. For a corporation, it's usually Chapter 11, which allows them to reorganize.
It's not just a financial failure, then. It's a legal framework.
It is. It's designed to minimize the chaos, to provide a systematic way to distribute assets, and, in theory, to offer the debtor a legal, if very painful, fresh start.
So let's move from the hard mechanics of finance to the soft wiring of the human brain. Let's talk about consumer debt. For most families, debt is the only way to bridge the gap between their current income and major life purchases.
It allows them to use their future purchasing power right now.
Right. It's a perfectly rational economic choice to finance a house or a car that you could never afford with the cash you have on hand. Mortgages, car loans, those are big, planned-out financial products.
But then you introduce the credit card.
Yeah.
And all of a sudden, the psychology of the transaction becomes the main thing driving the behavior.
And this is the critical insight, I think, for the listener. The real aha moment that's backed up by behavioral economics. We know people spend more and they get into deeper debt when they use plastic versus cash. Why is that friction so important?
It boils down to two related ideas: the transparency effect and the pain of paying.
Okay.
When you use cash, the transaction is totally transparent. You physically see the bills leave your hand, and you can immediately feel that your wallet is lighter. You can calculate what's left.
And that visualization, that physical act, creates a small emotional cost, the pain of paying.
Precisely. And what researchers have shown is that the farther the payment method gets from that physical cash exchange, from a credit card to tapping your phone to a one-click purchase online, the less real the spending feels.
The immediate pain of the loss is just gone.
It's diminished. And so you have less awareness, moment to moment, of how much you've actually spent. You're swapping a tangible loss for an abstract promise to pay later.
And the lenders, they know this. They benefit directly from that psychological gap.
Oh, absolutely. The whole system of plastic and digital payments is intentionally designed to lower the friction of spending. Our sources also brought up the specific monopoly money effect.
That's a great term for it.
It is, because credit cards look nothing like currency. They're physically different, so our brains don't subconsciously treat them like real money. It's a small cognitive trick that subtly encourages us to spend more because that psychological barrier is lower.
So really, the modern payment system is almost designed to bypass our natural cash-based sense of frugality. It's a structural vulnerability built right into the product.
It is. The irony is that a credit card is an incredibly powerful tool if you use it for short-term cash flow management and pay it off. But it becomes destructive when that psychological friction is successfully engineered out of the process, which leads to those high-interest revolving balances.
Now let's pivot to a whole other area, this huge, largely untracked world of informal debt. This isn't banks and plastic. This is loans between friends or family or people in a community.
This is a massive area, especially in lower-income communities or developing economies. And the main reason for it is a simple lack of access to affordable, formal credit.
So when the banks say a borrower is too risky or the amount they need is too small to be profitable,
They have to turn to their social network. It's a loan of necessity.
and this kind of debt has a whole different set of risks, right? It's not about your credit score, it's about your social standing.
Absolutely. When you default on a bank loan, the consequences are financial repossession, bankruptcy. When you can't pay back a friend, the consequences are social and relational, and they are often immediate.
And the data on this really shows the scale of the problem. That statistic from the EU back in 2011, 8% of all households reported being behind on informal loans.
8%. That represents millions of families where financial problems immediately become severe social tensions, family fights, a loss of community support.
And the person they owe money to often needs that money back just as desperately.
It creates this double bind of poverty and strained relationships. It's a huge hidden social cost when people are excluded from the formal credit system.
Okay, we're moving up the food chain. We're going from an individual's car loan to the sophisticated instruments that mega corporations and governments use to fund billion-dollar projects. Let's start with the sheer variety of business debt.
For a business, debt is an engine for growth. And as you said, the simplest form is the term loan, a fixed amount of money for a fixed period of time.
And if that loan is structured so you pay interest, but the whole principal is due at the end.
It's often called a bullet loan, one big payment at the end.
Now, there's a relatively new idea that's really gaining traction, especially with startups. It's called revenue-based financing, or RBF. This seems like a great compromise for founders.
It's revolutionary, really, because it solves the control problem. With RBF, you get capital up front, but your repayment isn't a fixed monthly amount. It's a percentage of your business's revenue.
So the payment goes up and down with your sales?
Exactly. They agree on a total repayment target, maybe 1.5 to 2.5 times the principal. If your sales are great, you pay it back quickly. If you have a slow month, your payment dips too.
So the lender shares in the revenue risk, but the business owner doesn't have to give up a huge chunk of equity to a venture capital firm.
Precisely. The founder keeps complete control, and they get a flexibility that rigid, amortized debt just can't offer. It really aligns the interests of the lender and the borrower with how the business is actually doing.
Okay, next up, the tool used when the amount of money needed is just immense. The syndicated loan. If a single bank can't handle the risk of a $5 billion loan to an energy company, what do?
They syndicate it. A group of lenders, maybe a dozen big banks, pool their money to provide the capital. One or two of the major banks will act as the arrangers. They structure the deal, they do the due diligence, and they find the other lenders to join the syndicate.
And what's the main reason for doing this, from the lead bank's point of view?
It is a core risk management tool. By spreading that massive loan across many different balance sheets, the lead bank lowers its own specific risk. It also frees up their regulatory lending capacity so they can serve other clients.
So it's how systemic risk is intentionally spread out across the financial sector?
It is.
But doesn't spreading the risk so widely make it harder to manage if there's a problem? I mean, who's actually in charge?
That's the job of the administrative agent. It's one of the lead banks that's appointed to manage the loan for the entire syndicate. They handle all the communication, distribute the payments, monitor the loan terms, and manage any potential defaults.
So the risk is spread out, but the management is centralized.
Exactly. You need that for coordination.
Now let's move to the other huge category of large-scale debt, bonds. A bond is different from a loan because it's a debt security.
Correct. Bonds are fixed income instruments. They have a defined face value, a fixed lifetime, often many years, sometimes decades. And most of them include regular interest payments, which are called coupons, that are paid to the bondholder. Then the full principal is repaid at maturity.
And what are the key things that determine a bond's price and risk, beyond just that coupon rate?
Well, there are three main variables. First is the par value, which is the principal amount you get back at the end. Second is the duration, which is a measure of how sensitive the bond's price is to changes in interest rates.
So a longer duration means it's riskier if rates are going up.
Much riskier. And third is the yield, which is the total return an investor gets, combining both the coupon payments and any change in the bond's market price. Understanding how coupon, yield, and duration all interact that's the heart of bond trading.
Let's talk about a very specialized tool, the letter of credit, or LC. This is essential for high-value international trade.
The LC is an agreement where a bank, on behalf of a buyer, promises to pay a seller a certain amount of money, but only if the seller presents specific documents proving they did what they were supposed to do.
So the genius here isn't the document itself, it's that the bank is substituting its own credit risk for the buyers, right?
Absolutely. Think about it. A supplier in China might not trust a buyer in America to pay them, and the American buyer might not trust the supplier to actually ship the goods. The bank steps into the middle and replaces the uncertain credit risk of the buyer with its own rock-solid creditworthiness.
And because nearly all LCs are irrevocable, both sides know the bank has to pay if the documents are correct.
Right. And those documents are very specific. They have to prove the goods were shipped and inspected. You typically need the commercial invoice, an insurance certificate, and the most important one, the bill of lading.
Which proves the goods were physically handed over to a shipping company.
Exactly. This strict reliance on the documents, not the goods themselves, is what makes the system so effective and hard to defraud.
Now, let's tie all these complex tools back to corporate strategy. Why do companies do all this? To get leverage.
Leverage is simply using borrowed money to amplify the return on the equity that the owners have invested. If a company can borrow money at 5% interest and use it to build a factory that generates a 15% return, the shareholders see a much bigger profit than if they had only used their own cash.
But as we said, debt always increases risk. So how do analysts figure out that line between smart leverage and, catastrophic over-leveraging?
By measuring the leverage metric, the ratio of debt to equity. Things like the debt-to-equity ratio or debt-to-assets ratio are watched constantly. High leverage means high potential returns, sure, but it also means the company is incredibly vulnerable to an economic downturn or even a small rise in interest rates.
If the return on your investment drops below the cost of your debt, leverage starts working against you very, very quickly.
It can destroy shareholder value in a heartbeat.
Shifting to the biggest scale of all, government debt. This debt is so huge, it basically forms the bedrock of the entire global financial system.
This is debt issued by sovereign nations or by local governments. In the United States, we're talking about Treasuries, the notes, bills, and bonds issued by the U.S. government. These are the global reference point for almost every other debt instrument in the world.
Why are Treasuries the undisputed global benchmark?
Because they meet every single criterion for financial perfection. The market for them is the deepest, most liquid, and most transparent on Earth. They're issued across a huge range of maturities, from a few days to 30 years. And that liquidity and reliability allows everyone in finance to use the yield on a treasury as a proxy for the theoretical risk-free rate.
So even though nothing is truly risk-free, the U.S. government's ability to pay, which is backed by its power to tax and print currency, makes its debt the safest practical investment out there.
It's the closest thing to a guaranteed return of principal that exists on a global scale, which is why central banks and institutions all over the world hold treasuries as their main safe haven asset.
Now, when we're assessing a country's ability to handle this massive debt, the absolute dollar amount can be misleading. You have to look at the debt-to-GDP ratio.
This ratio is critical. It puts the size of the debt into context against the nation's total economic output, its ability to generate income. It tells us how easily that country can, in theory, pay down that debt. A country with high debt but very high GDP growth might be less of a concern than one with lower debt but a stagnant economy.
And this isn't just a problem for rich countries, it's a huge global humanitarian issue.
It is. The UN's Sustainable Development Goal 17 specifically targets the external debt of highly indebted poor countries. For these nations, their debt load is a massive barrier to development. It traps them in a cycle where almost all their tax money goes to paying interest instead of to things like education or healthcare.
And finally, let's quickly distinguish between federal debt and local debt municipal bonds.
Municipal bonds, or munis, are essential for local government. They're issued by cities, states, local authorities, but crucially, they're used only for financing large, long-term capital projects.
So, new schools, upgrading the water system, building roads.
Exactly. They are never used to pay for day-to-day operating expenses like police salaries or keeping the lights on. That restriction is key to their fiscal stability.
Okay, so we've laid out all the different types of debt, but the fundamental question for any lender is always the same. Am I going to get paid back? Now we're going to look at the metrics and the gatekeepers that answer that question for everyone, from a family buying a house to an investor buying corporate bonds.
We have to start with income metrics. These measure if there's enough cash flow coming in to cover the debt payments. This is the first line of defense against default.
And the gold standard for businesses and investment properties is the debt service coverage ratio, the DSCR.
The DSCR is calculated by taking the income that's available, the net operating income, and dividing it by the total annual debt payments, so interest plus principal. A ratio of 1.0 means your income just barely covers the debt.
And anything below that, you're in real trouble.
You're losing money on the deal, which is why lenders always require a significant buffer above 1.0.
What's a typical requirement?
For commercial real estate or corporate lending, a ratio between 1.2 and 1.5 is often the minimum. A higher DSCR signals that you're in better financial health, which means you'll get easier, cheaper financing because the risk of you defaulting is lower.
Now, for our individual listeners, the closest thing to the DSCR is the standard for U.S. mortgages, the debt-to-income ratio, or DTI. And these ratios are incredibly rigid. They're like industry-wide rules for getting a standard loan.
They are very precise gatekeepers. The DTI measures your total required monthly debt payments against your gross monthly income. And lenders look at it in two parts.
The front-end ratio is just your housing costs, the mortgage, property tax, insurance. What's the target there?
28% or below. If your total housing costs are more than 28% of your gross monthly income, the loan starts to be seen as non-conforming. It's riskier.
And then there's the back-end ratio, which is even broader.
The back-end ratio includes all your housing costs plus every other scheduled debt payment you have, car loans, student loans, minimum credit card payments.
And the target for that?
36% or below. Typically, you have to meet both of these thresholds for the loan to be considered safe and standard. The fact that these lines are so rigid, 28 and 36, it just shows how much lenders rely on historical data to predict who is likely to pay them back.
Next, we move from income to the security of the asset itself, value metrics. The main one here is the loan-to-value ratio, or LTV.
This one's very straightforward. It's the total loan amount divided by the value of the collateral. If you borrow $80,000 for a property that's valued at $100,000, your LTV is 80%.
Which is the same thing as making a 20% down payment.
It's just the inverse way of saying the same thing. And lenders love low LTVs. It gives them a substantial equity cushion, a buffer, if they're forced to repossess and sell the collateral. That V in LTV is always checked by the purchase price and usually a third-party appraisal.
Okay, for big institutional borrowers like corporations and governments, creditworthiness is assessed by specialized companies, the rating agencies. These are the real gatekeepers of the global capital markets.
Companies like Moody's, S&P, Fitch, they are indispensable. They provide an independent, objective rating on a borrower's ability to pay their debts on time. Their ratings guide trillions of dollars in investment decisions.
And how does their system work? How do they boil down all that risk into a simple grade?
They use alphabetical scales, usually with pluses and minuses. Moody's, for example, goes from AA, which is the highest quality, almost no risk, all the way down to C. S&P uses a similar system with capital letters, AAA, AA, BBB, and so on. The really important line is the one between investment grade,
which is low risk, high quality.
Right, usually AAA down to BBB.
Yeah.
And everything below that, which is called speculative grade.
And the power of those letters is just immense. A single change in a rating can send shockwaves through the financial system.
A downgrade can be catastrophic for a company. Its cost of borrowing is directly tied to its rating. If a rating falls from, say, BBB to BB plus grade, it crosses that line from investment grade to junk status.
And what happens then?
A huge group of institutional investors, pension funds, insurance companies, who are legally required to only hold investment-grade bonds, they have to sell that company's bonds immediately.
That selling pressure drives the bond price down.
And the company's borrowing cost shoots up, which can put its entire financial structure at risk.
Which brings us right to that high-risk, high-reward world, Junk bonds.
These are simply bonds that are rated below investment grade, so below BA or BBB. They're called speculative because their default risk is much, much higher than investment-grade debt. Our sources show that even for the better junk bonds, the average default rate is around 1.6%, which is many times higher than for a AAA-rated company.
So why would an investor ever buy them?
Compensation. The high risk is offset by much higher interest payments, higher coupons.
Hmm.
Investors who are willing to take on that risk demand to be paid a premium for it, and junk bonds are actually crucial for financing smaller or riskier companies that can't get access to cheap investment-grade capital.
And when those risks actually happen, when a company defaults, the debt becomes bad debt.
Bad debt is just debt that's in default and is not likely to be paid back in full. But even these assets still have some value. They're often repackaged and sold by the original lenders, sometimes for pennies on the dollar, to specialized distressed debt funds. It's a whole secondary market for high-risk trading.
Let's clarify a really fundamental difference in how these markets are structured. The difference between loans and bonds.
A bond is inherently a debt security. It's standardized, it's tradable, it's registered with a code like a CUSIP number, and it's designed to be bought and sold instantly on an exchange. A loan, on the other hand, is usually a private contract between a borrower and a lender or a syndicate of lenders. It is generally not a security.
But that line gets intentionally blurred by a process called securitization. This is complicated, but it's essential to understanding modern finance.
Securitization is the process of taking assets that are not securities, like a big pool of individual home mortgages or auto loans or student debt, and converting them into tradable securities.
So how does that actually work? Give us the deep dive version.
The bank that made the original loans sells a huge pool of them to a special entity, usually a trust. That trust then finances the purchase by issuing securities to investors. A classic example is taking a pool of home mortgages and turning them into residential mortgage-backed securities, or RMBS.
And these new securities, they're not all the same. They're issued in different levels of seniority called tranches.
Yes, and the tranches determine who gets paid first. You have senior tranches, which are rated highly and have low risk, then mezzanine tranches with medium risk and return, and finally the equity or junior tranches, which have the highest risk and the highest potential return.
So the payments from all those mortgages flow through a structure like a waterfall.
Exactly. The principal and interest collected from the homeowners flows first to the senior tranches, then to the mezzanine, and whatever is left over goes to the junior tranches.
So if some of the homeowners default on their mortgages, the junior tranche takes the first hit, which protects the senior tranche. It's a way of slicing up risk and selling it to different investors based on their appetite.
It's a very sophisticated risk transfer mechanism that turns illiquid loans into highly liquid tradable assets.
Finally, let's wrap this part up with the huge role of central banks, like the Federal Reserve, because debt is always in a specific currency.
The central bank's control over monetary policy, so inflation and currency value. It directly changes the effective size of that debt. If you owe $100,000 at a fixed interest rate, and then you get a surprise burst of high inflation, the real purchasing power of the money you have to repay is significantly lower.
So inflation helps fixed-rate borrowers and hurts fixed-rate lenders.
It creates a massive redistribution of wealth. And the opposite is true in a deflationary environment. The currency gets more valuable, which increases the real burden of the debt. So central bank policy is this active force that can either ease or worsen the real weight of debt on an economy.
We've spent most of our time talking about ratios, leverage, securities. Now we have to zoom all the way back in on the individual. Because when this sophisticated system fails at the personal level, the cost isn't just financial, it's deeply human.
This transition is so important. When a family takes on debt, they're making assumptions about stable income, about their job, about their relationships. Over-indebtedness is what happens when life events just blow those assumptions apart.
And these triggers are sadly common and often completely outside of a person's control.
They are a serious illness that means you can't work, an unexpected layoff, a relationship breaking up that cuts the household income in half, a small business that fails. In those moments, the debt load goes from being a financial tool to a state of chronic, crushing social distress.
And let's detail the severe consequences that have been documented in systematic reviews, because it's so much more than just getting calls from debt collectors.
The health impact is profound, and it's proven. Over-indebtedness is strongly linked to poor physical and mental health. We see increased rates of anxiety, depression, stress-related illnesses. The constant worry creates a state of chronic stress that just degrades a person's quality of life.
And I imagine that stress spills over immediately into your home and social life.
It does. It causes major family stress and relational tensions. It often leads to isolation, the breakdown of marriages and families. And then there's the stigma of financial failure, which creates new barriers. It can make it hard to get a new job, and it can lead to exclusion from basic financial services, like even opening a checking account.
And this spirals out into the wider economy too, right? It affects productivity.
Absolutely. For people who manage to stay employed while they're over-indebted, studies show higher rates of absenteeism from work and a clear lack of organizational commitment. This perpetual feeling of insecurity infects every part of life. It's a systemic problem, not just a personal one.
Given this huge documented social failure, it becomes really insightful to look back thousands of years and ask how ancient societies handled this exact same problem. So let's turn to the history of debt and forgiveness.
Debt is ancient. The lending of what they called food money, so seed and food to survive, was common in Middle Eastern civilizations as far back as 5000 BC. In those farming societies, if you had a bad harvest, debt didn't just mean financial ruin. It could mean losing your land and sometimes the enslavement of your entire family.
Which is a direct threat to the stability of the whole society. And that's why ancient religions stepped in with mandatory resets.
Exactly. Religions like Judaism and Christianity saw that debt wasn't just a private contract. They saw it as a social lever that, if you left it unchecked, could create permanent class divisions and mass poverty. So they built systematic debt forgiveness right into their laws to prevent these systemic inequities.
And the most dramatic example of this is the biblical Jubilee year in the book of Leviticus. This was a mandated total economic reset.
Every 50 years, the Jubilee required the complete return of ancestral lands to their original owners and the forgiveness of all debts. On a smaller scale, you see in Deuteronomy 15.1, a call for debts to be forgiven every 7 years. These weren't suggestions. They were laws designed to stop wealth and power from concentrating in the hands of a few creditors.
And this philosophy also frames debt as a moral issue, advising people not to get into it in the first place.
That's the traditional Christian teaching. It strongly cautions that a lifestyle of debt should not be the norm. They cite scriptures like Romans 13.8, "Owe no man anything but to love one another." The focus isn't on punishing the creditor, but on protecting the debtor and the whole society from the instability that permanent debt creates.
It's just fascinating that these ancient systems prioritize social cohesion over the absolute sanctity of a private financial contract. They understood that an economy that's constantly eating its own citizens through chronic debt will eventually fail.
The focus was on sustainability, on preventing the creation of a permanent, desperate underclass. It shows this powerful awareness that financial systems have to be designed to handle the inevitable shocks and failures of human life. #outro.
What a journey. We started this deep dive in the very sophisticated world of financial engineering, analyzing the difference between a bullet loan and RBF, detailing how risk is sliced into tranches, understanding why the DSCR ratio drives lending costs.
And we ended by focusing on the catastrophic personal fallout of being over-indebted, the measurable damage to mental health, to family stability, to careers. The sophisticated financial tools of today stand in such stark contrast to the deep personal anxiety that debt creates.
So our key takeaways for you today have to bring that contrast together. First, just recognize the psychological power of your payment methods. Understand that the design of credit cards and digital wallets is meant to reduce that pain of paying, and just be mindful of that manipulation. Second, when you're assessing risk, whether it's personal or corporate, learn the quantitative language, DSCR, LTV, and the huge impact that those agency ratings have on the global cost of money.
And finally, that really enduring question that ancient history leaves us with. We have comprehensively documented the massive social and mental costs of over-indebtedness today. We know that ancient societies, when they saw this cycle of debt turning into poverty and systemic failure, built mandatory systemic debt forgiveness, like the biblical Jubilee rite, into their social contracts as a necessary reset. So what does that ancient mandate, which was focused on long-term sustainability and preventing inequality, what does that suggest about the ethics and the structural rigidity of our modern financial system, which is built fundamentally on the principle of non-forgiveness?
It really raises the question of whether our current definition of economic efficiency truly accounts for the deep societal costs of human failure, something powerful to explore further. Thanks for joining us for the deep dive.